Trading courses sell a dream. Learn this system, follow these rules, and you'll be printing money in months. Some of them cost thousands of dollars, and almost none of them will show you what actually happens when you run their claims against real data. So I did. 5 of the most common things trading courses teach, tested against actual market behavior and actual trader outcomes. Some of these aren't just exaggerated. They're the exact reason most traders lose money in the first place. Nearly every course starts here. Learn to read the chart, spot the pattern, predict the next move. It's the entire premise of technical analysis as it's usually sold. If you study candlesticks and indicators hard enough, you'll know what happens next. Here's what the data actually says. Markets are overwhelmingly dominated by near-random short-term price movement layered on top of real information. Academic studies on technical trading rules, going back decades across thousands of tested strategies, consistently failed to show reliable predictive edge once you account for transaction costs and data mining bias. The traders who are actually profitable long-term aren't predicting the future. They're managing probability and risk on setups that have a small statistical edge, and even then, they're wrong close to half the time. Prediction is the marketing pitch. Probability management is the actual job. Stack 5 indicators on your chart, and you'll filter out the noise, right? RSI, MACD, Bollinger Bands, a couple of moving averages, maybe a custom oscillator on top. Courses love teaching confluence. The idea that when multiple indicators agree, you found a high probability setup. The data says the opposite happens. This is a textbook case of overfitting. The more variables you add to a system, the more it starts fitting to noise in the historical data rather than an actual repeatable edge, and the worse it tends to perform out of sample. Every indicator you add doesn't add more truth. It adds more ways for your system to accidentally match the past instead of predicting the future. This is the big one. A course shows you a backtest with a smooth, beautiful equity curve climbing up and to the right over 5 years, and says this is the strategy. It looks like proof. It's usually the least trustworthy part of the entire pitch. Backtests can lie in several specific ways. Survivorship bias. Only testing on stocks or assets that still exist today. Curve fitting. Tuning the strategy's parameters until it happens to match the historical data perfectly, and ignoring slippage and fees that would have eaten the real returns. A backtest isn't proof a strategy works. It's proof that under one specific set of historical conditions, with the benefit of hindsight, a curve could be drawn through the past. That's a very different thing than a strategy that will hold up going forward. This is the one that gets people to actually buy. Replace your income. Quit the 9-to-5. Trade for a living within 3, 6, 12 months. It's less a trading claim and more a sales tactic. It's selling urgency and a lifestyle, not a realistic timeline. The real data here comes from actual retail trader outcome studies, not course marketing. A widely cited study tracking Brazilian day traders over multiple years found that among those who persisted for more than 300 days, roughly 97% lost money, and fewer than 1.2% earned more than Brazil's minimum wage from trading. Regulators in the EU and UK require retail brokers to publicly disclose what percentage of their retail clients lose money on leveraged products, and those disclosed numbers routinely sit between 70 and 80%. That's not a knock on trading as a skill. It's a direct contradiction of quit your job in 3 months. The people who actually make it tend to take years, not months, and most people who try don't. This one sounds responsible, which is exactly why it's so effective as a sales pitch. Position sizing rules feel like real risk management, and to be fair, they are part of it. But courses often present it as the whole solution. Follow this one rule and the strategy's edge takes care of the rest. Here's the problem. Position sizing controls how much you lose on any single trade. It does absolutely nothing to fix a strategy with negative expectancy. If your system loses money on average, risking 1% per trade instead of 5% just means you go broke slower, not that you stop going broke. Risk management protects a good strategy from ruin. It cannot turn a bad strategy into a good one. Courses that sell position sizing as the fix for everything are selling you half the truth. None of this means trading is a scam or that every course is worthless. It means the specific claims that get used to sell courses: predictable patterns, indicator stacks, clean backtests, fast income, and risk rules as a cure-all don't hold up against real data. The traders who actually succeed tend to operate on the boring version of all five: probabilistic edges, simple systems, honest backtesting, multi-year timelines, and risk management paired with an actually profitable strategy. If you want to see the exact backtests behind any of these claims, let me know in the comments which one you want broken down in full. And subscribe, because that's exactly the kind of video coming next.